So this was inevitable. This was a decade or more coming. I think what's suspicious is the timing of this, right around the beginning of budget discussions for the next fiscal year.
On May 15th, 2025, the unthinkable happened. America lost its final AAA credit rating. Within a day, China pulled back $765 billion in U.S. debt, sending shockwaves through global markets. Bond yields soared, gold prices exploded, and the dollar sank to its lowest in years. What was once the world's safest asset just turned toxic. This isn't just a downgrade, it's the start of a global shift. And it's already underway. It finally happened. The warning signs turned into reality. On May 15, 2025, Moodys stripped the U.S. of its last AAA credit rating, cutting it to AA1. For over a century, America's credit had been the gold standard. Not anymore. Moodys pointed to out-of-control debt and a lack of political action as the key reasons. Interest costs have now soared to over $870 billion a year, up 32% since 2023, taking up nearly a third of all federal revenue. That's money lost to interest, not progress. The downgrade sent shockwaves through global markets, bond yields jumped, foreign investors hesitated, and the trust that once held everything together began to crack. This wasn't just a credit downgrade, it was a turning point for the global financial system. Just weeks before the U.S. downgrade, China made a quiet but powerful move. In March 2025, it slashed its U.S. Treasury holdings to $765.4 billion, the lowest level in over 20 years. That's not just a number, it's a signal. For decades, China was one of America's biggest lenders. Now it's stepping back. According to U.S. Treasury data, Japan has overtaken China as the second largest holder of U.S. debt, with over $1.13 trillion. Experts like Brad Setzer from the Council on Foreign Relations say China isn't fully dumping the dollar, but it is reducing risk by shifting to shorter-term bonds. This strategy gives China flexibility while avoiding long-term exposure to U.S. debt. The timing couldn't be clearer. The shift happened right after Trump's April 2nd tariff hikes and just before the Moodys downgrade. It's not a panic sell, it's a strategic retreat. But when the world's second-largest economy takes a step back, smaller nations start to rethink their own positions. As faith in U.S. debt began to fade, gold took off. In May 2025, gold prices surged to $3,233.50 an ounce, up more than 23% since the start of the year. After the Moodys downgrade, investors rushed to safety. And they didn't pick bonds, they picked gold. Goldman Sachs doubled down on its prediction. Gold could hit $4,000 by mid-2026. At the same time, the U.S. dollar took a hit. The Bloomberg Dollar Spot Index dropped nearly 4% in April alone, reflecting weakening confidence in U.S. fiscal leadership. Central banks across Asia and the Middle East responded by increasing gold reserves. The message was clear: real assets are safer than paper promises. As inflation eats into returns and debt piles up, gold isn't just a hedge, it's becoming the new global safe haven. With China stepping back, the spotlight turned to other major players in the global bond market. As of March 2025, foreign investors still hold over $7.4 trillion of the $22.3 trillion in marketable U.S. debt, according to Treasury data. But that balance is shifting. While countries like Canada and Belgium slightly boosted their holdings, the broader picture shows slow erosion. European institutions are showing signs of hesitation, especially in long-term bond commitments. Even Japan, now the largest foreign holder at $1.13 trillion, is starting to reduce its exposure at the long end of the yield curve. Meanwhile, U.S. retail investors make up just 11% of Treasury holders. Unlike central banks, they're far more likely to panic during a downgrade cycle. Experts warn it doesn't take a mass sell-off to shake the system. If foreign lenders simply pause on buying new debt, It could tip the scales. Supply starts to outweigh demand and yields spike. That means higher interest payments, tighter budgets, and more pressure on a government already stretched thin. Silence from America's creditors is no longer quiet. It's deafening. On April 2, 2025, former President Donald Trump reignited the global trade war with a bold 30% tariff hike on Chinese electronics, metals, and machinery. But instead of cornering Beijing, the move shocked global investors, and the pain hit America first. Within just 3 weeks, the 10-year Treasury yield spiked from 3.86% to 4.59%, according to CNBC, as markets braced for retaliation. China didn't scream or shout, it responded with strategy. It shifted away from long-term bonds and quietly trimmed its exposure, signaling deep concern without making noise. Then came May 19th, when Treasury Secretary Scott Bessent issued a stark warning: any country not negotiating in good faith would face tariffs above 10%. The result? Panic. The 30-year Treasury yield shot up to 5.03%, its highest in years. This wasn't just a bond market reaction, it was a political message. Investors started seeing U.S. Treasuries not as a safe haven, but as a geopolitical tool that could turn on them. That change in perception is subtle but powerful, and it's rewriting the rules of global finance in real time. As borrowing costs rise, the U.S. government seems to be leaning on inflation to boost GDP without making real cuts to spending. In the first quarter of 2025, real GDP grew just 1.1%, while inflation climbed to 4.2%, according to the Bureau of Economic Analysis. That pushed nominal GDP to 5.3%, but much of that gain came from rising prices, not actual growth in output. The Congressional Budget Office warns that every 1% rise in interest rates adds around $240 billion in annual borrowing costs. With 10-year yields now close to 4.6%, that burden is accelerating. Congress is advancing a $2.8 trillion deficit expansion, while the Senate has proposed an even larger $6 trillion package. Together, they could add nearly $600 billion per year to the national debt. Supporters claim the stimulus will boost GDP and support job creation, but inflation is eating away at those benefits. It may make the economy look stronger on paper, but underneath, the debt problem keeps growing. Inflation may inflate the numbers, but it doesn't fix the debt. The real risk today isn't default, it's devaluation. Investors may still get their money back from U.S. bonds, but it'll be in dollars that buy less every year. And that's the shift troubling the markets. While U.S. Treasuries are still treated as risk-free by regulatory rules, trust is no longer automatic. Analysts at Goldman Sachs say the exceptionalism premium that once made U.S. debt special is fading fast. With yields rising and inflation-adjusted returns in the red, more investors are asking, what's the point of holding these bonds? Retail demand is cooling and foreign buyers are growing quiet. The Fed could step in with large-scale bond buying, essentially printing money to cover the gap, but that only makes the inflation story worse. And the deeper issue is credibility. If global markets stop believing in Washington's ability to manage its finances, even the strongest institutions won't be enough to hold the system together. This isn't just about economics anymore, it's about trust. And once that cracks, the damage spreads far beyond interest rates. As confidence in U.S. debt begins to erode, global capital is quietly flowing toward tangible assets. Central banks across Asia, the Middle East, and Latin America are steadily increasing their gold reserves and pulling back from long-term U.S. Treasuries. According to the IMF's April 2025 reserve data, sovereign gold buying has reached its highest level since 2010, with China, India, and Turkey leading the surge. These aren't short-term plays, they're strategic moves to reduce exposure to dollar volatility. Several oil-rich nations, including those in the Gulf, are redirecting sovereign wealth into commodity-backed funds, especially in energy, agriculture, and industrial metals. Meanwhile, China is pushing ahead with BRICS plus trade settlement systems that bypass the US dollar altogether, relying instead on gold, oil, and digital currencies. This isn't a dramatic exit, it's a slow but deliberate shift. And it signals something deeper, a global recognition that US debt, once seen as unshakable, is becoming a liability. When your biggest trading partners start insulating themselves from your economy, the message is clear. The world is preparing for a future where treasuries may no longer be king. The real danger isn't a crash, it's the quiet exit of trust. As China steps back and debt piles up, the foundation of US power is starting to crack. Subscribe now for more deep dives into the shifts reshaping the global economy.